Good afternoon, and thank you so much for joining us for today's web seminar. I'm Karen Weiskopf, Vice President of Marketing at First Long Island Investors, and I'm joined today by Robert D. Rosenthal, our Chairman, CEO, and Chief Investment Officer, Philip Malakoff, Senior Vice President of Wealth Management and Director of Research, and Brian Gambo, Vice President of Wealth Management. Before we begin, a few very quick logistical items. All participants are currently in listen-only mode. Second, after the team delivers a presentation, we'll have time for Q&A. You can feel free to submit your questions throughout the presentation through the dialog box on your screen. Everybody at this point should see a slide with the headline, Today's Speaker. If you don't, please type something in the chat area and we will do our best to help you troubleshoot. Finally, our General Counsel has asked that I remind you that today's session may discuss the performance of some strategies and that past performance is not a guarantee of future results. I now hand it over to Bob.
Thank you, Karen. Good afternoon, and I hope that everyone on this call had a wonderful summer and is looking forward to the fall. The quote that we've chosen for this webinar is the conventional view serves to protect us from the painful job of thinking. And that was a quote from John Kenneth Galbraith, who was a famous American economist and diplomat, although candidly, he was born in Canada. We do not accept the herd mentality at First Long Island. We probe the conventional view, and sometimes we act in a contrarian way. You'll hear more about that a little bit later. Our agenda today is similar to agendas in past webinars. We'll talk about the state of the markets, signs of a reasonable U.S. economy, and we'll give you evidence of that. We'll talk about the wall of worry, which continues to grow, our investment approach, and then as Karen suggested, we'll have a time for questions and answers. But let's start with the state of the U.S. markets. First, some good news in our opinion. This afternoon, about 45 minutes ago, the Fed announced that they were cutting interest rates, short-term interest rates, by 25 basis points, and that there's a potential for another cut. That'll be based on data that comes forward in the next several months. This is important in our opinion that there was a cut because about a year ago, Fed Chairman Powell made a misstep, talked about increasing rates, and that led to a fairly precipitous drop in equity markets in the fourth quarter. He then walked off that plank in January, and we've had a much better year, as you can see. Right now, the S&P is up approximately 18% year to date. The Russell 1000 Growth Index is up 23%. And as you know, we have a significant allocation for our clients to growth, so we've enjoyed something better than the 18%. And you'll see that the Russell 1000 Value Index is up 14%, which again is trailing the Growth Index. So we've seen a pattern of growth outpacing value, and that's been reflected in our asset allocations. Also reflected in our asset allocations is a very modest exposure to the international economy through companies domiciled outside the U.S. So as you can see, the EFA index and the All World ex-US are only up 9 or 10% versus the domestic indices that are up anywhere between 14 and 23%. So again, we have favored domestic companies. Even though they do business overseas, they're domiciled in the US, and that has been a pattern now for many years. As you can see from these line graphs, being a long-term investor has paid off. We've made significant monies being a long-term investor in the various markets that are demonstrated here. However, we've had to withstand some downturns. And whether it was the recession in 2008 or some gyrations in the last several years, being committed to long-term investing has paid off significantly. And we believe that will be the case in the future, but more on that later. The next chart is the CBOE Volatility Index, otherwise known as the VIX. And this is an indication or a measurement of volatility in the market. And all of us as investors are confronted by volatility and sometimes a bit afraid of it. although we view the volatility as an opportunity to invest in high-quality companies at a better price. But this volatility is increasing slightly, as you can see on the right side of the chart, although not much above the average that we've had over the past 40 years. The volatility today is being created by trade and China, the dispute there, the potential of a recession, which has been talked about a lot, although we don't see it in the foreseeable future, and we'll spend more time on that later. Iran and the geopolitical issues in the Middle East, our own internal politics relating to the upcoming election next year, and of course what the Fed was going to do. That volatility has been removed from the table, at least for the foreseeable future, with the 25 basis point cut. But the volatility that we're feeling now, we're experiencing now, although it seems like a bit or a lot, it is not extreme and is nothing more than we've weathered in the past. The next page are the economic positives. We have a reasonable domestic economy, and this is why we continue to say to you, our clients and colleagues, we do not see an imminent recession. And every time the market gyrates, the pundits start to write, we're facing a recession. We honestly don't see it at this point. If you look at the green line, that's our current expansion, which is averaging about 2.3% GDP growth. The red line represents the longer-term average, representing 2.1%. So our current expansion, which is going on for quite a while now, since the recession in 2008, beginning of 2009, is showing a moderate growth for our economy. And that's despite the headwinds. We would anticipate that GDP growth over the next year or so will average somewhere between 1.8% and 2.3%. Again, these are growth numbers. We see our GDP growing. That is not recessionary. The chart to the right, components of nominal GDP, is an important chart because it shows in the blue section, consumption, 68%, really represents the consumer in our economy. We have a consumer-driven economy, which is about 68% of the economy. And as you will see going forward, the consumer is quite strong, and we'll have some charts to depict that. So again, at this time, we do not see a recession in the foreseeable future, certainly not over the next year. We turn to the next page, or next slide, you'll see that we have some significant economic positives. Number one, unemployment is incredibly low, currently about 3.7%, and the long-term average is closer to 6%. That shows the strength of the economy. And I believe it was last week or so, we had some economic data on employment, which did not capture the household employment. So even though it was a positive 130,000 new jobs, it didn't capture some of the household employment numbers, which were even more robust. So at the end of the day, we have a strong consumer, we have low unemployment. What's critical to go along with that is inflation. And as you can see from the chart on the lower left, inflation today is a bit less than 2%, and that is low. And that's what the Fed is concerned about, so that's why they continue to drop rates. They're trying to get us to 2% inflation. So we've got strong consumer growth, we've got strong unemployment or low unemployment, we've got low inflation, and adding to that, to make it an even better picture, is that we've seen an uptick, a real uptick in wages. The chart on the lower right shows that. We're trending towards the long-term average of 4%. Now, what's really important as we view that chart along with the other charts on this page is that we've got low unemployment, a lot of people working, we've got inflation under control at less than 2%, and we've got real wages upticking close to 4%. So the way we view it, you've got wage growth between 3 and 4% and inflation at less than 2%. That leads to a real strong consumer, and we'll show you some slides on that as well. If we turn to the next slide, continuing with economic positives, you'll see that there's an unprecedented deleveraging of U.S. household balance sheets. Now, we all know that when we faced the decession, which we call a decession, somewhere between depression and recession back in 2008 and beginning of 2009, households were very levered. Since then, you've seen this chart or this line graph go down significantly. So the decession led to a deleveraging. That's a very positive for our consumers who are driving the economy. However, we are watching corporate debt, which is somewhat higher because of low interest rates, and that's something that we have a little bit of concern about, and we'll be watching that and reporting on that as time goes on. The chart on the right, consumer confidence is at a 2-decade high, is critically important. As we mentioned before, 68% of our domestic economy is driven by the consumer. And with consumer confidence at a 2-decade high and a deleveraged balance sheet, that positions the consumers in America to be strong and help support a growing economy. We turn to the next slide. Corporate fundamentals are reasonable. Now that's a change. They've been more robust in the past. S&P earnings are still growing, but slowly. So as you can see from the line graph, or the bar graph, S&P earnings are projected to be $164 a share, going up to $182, and then in 2021, $200. Those numbers may come down a bit, but the key is they're still growing, although more slowly. And as if you look at the bar graph for 2017 to 2018, you'll see that big increase from 132 to 161. A good part of that was the Tax Reform Act, where corporate taxes were reduced. So we're still getting the benefit of that, and as you can see, S&P earnings continue to grow. Now, because S&P earnings are growing more slowly, we believe active management in selecting the companies that we invest in is really critical. With slower GDP and slower earnings growth, active management of picking the highest quality companies that have the durability of growing their earnings should really pay off. And that's what we do for you here at First Long Island. Now, we turn to the next slide. Valuations have normalized. And what does that mean? The long-term PE average is about 15.2, price-earnings ratio, on the next 12 months. The current PE on the next 12 months is 16.8, somewhat above that long-term average. Now, we're not terribly concerned about that, and we don't believe that's nosebleed territory by any stretch, because also important on this slide are the long-term interest rates for the 10-year Treasury. And as you can see, they're currently, and this was as of the end of August, at 1.5. They've jumped back up to about 1.6, 1.7 this afternoon, way below the long-term average of 5.1% for the 10-year Treasury. We believe, and a lot of our colleagues believe, that low interest rates support higher valuations. So we've got a somewhat higher PE than average, but we've got long-term interest rates much lower than the average. That really helps valuations, in our opinion. Just to put this in perspective, if we go back to 2000, when we had the tech bubble, the PE on the next 12-month earnings at that time was in excess of 28. And you could buy a treasury at 6%, a 10-year treasury at 6%. So today, at 16 x 12-month earnings PE, with a 1.7 roughly 10-year treasury, we do not believe we're in nosebleed territory by any stretch from a valuation standpoint. And quite candidly, the alternative of buying a 10-year treasury with roughly a 1.7% pre-tax yield is not very attractive, and we'll talk more about that later. And now it's my pleasure to turn over the presentation to my partner, Phil Malikoff.
Thank you, Bob, and thank you to our clients and friends who are listening today. So I'm going to talk about the wall of worry, and there's an old Wall Street axiom which says that the stock market climbs a wall of worry. The more worries in the wall, the higher the market goes. And there are currently a number of items for investors to be concerned with. Bob, in his introduction, mentioned a bunch of them, and I'm going to go into greater detail in the next few slides. So let's start with worry number one, trade wars and tariffs. So the U.S. and China have been discussing and negotiating a new trade deal for more than a year, and with the next set of meetings scheduled for early October. During the process, there have been starts and stops, with both sides trying to get the advantage in negotiation. This has caused nervousness and volatility in the markets as investors react to the news of the day and tweets from the president and try to determine how all of this noise will affect our economy and ultimately our investments. The charts on this page show that while the tariffs do have an effect on our economy, the effect is not as large as some believe. The chart on the left shows that the expected impact that 2019 tariff announcements will have on our GDP. Tariffs enacted before May 5th are expected to have about a 0.25% negative effect. The next round of tariffs, which was on $200 billion of Chinese goods, raised that to about 0.4%, and subsequent increases in September and those proposed for October and December, assuming these take effect, will raise the cumulative impact on 2019 GDP to about 0.5% or 50 basis points. So there is an effect, but with GDP expected to be, this is hot off the presses according to the Fed, they just upped their estimate to 2.2% for this year. It's not going to be a major effect or a major one that investors have been concerned about. And a trade war and tariffs alone will not drive our economy into a recession, at least not in the near term. Another important factor to consider is that the U.S. has become a service economy and is not as reliant on manufacturing as it once was. This shift, which has occurred over the last 2 generations, has left us better able to endure a global trade and manufacturing slowdown, particularly compared with export-reliant countries like China. This gives the U.S. a subtle but important advantage in trade negotiations. One collateral impact of the trade wars and tariff negotiations has been the increase in trade with other Southeast Asian countries, as well as Mexico, all of which are low-cost producers of goods which we import in the U.S. The chart on the right shows that the year-over-year change in trade through July has been a reduction of $54.5 billion with China. That's a big amount. However, China's neighbors, Vietnam, Taiwan, South Korea, and India, have increased a combined $47 billion, nearly making up for this shortfall. When we include Mexico, which has increased by over $30 billion, we are actually showing a trade surplus of more than $23 billion. We believe that both leaders, President Xi and President Trump, are incentivized to reach an agreement or an interim deal, as both countries have important upcoming events. Obviously, the 2020 presidential election cycle will begin heating up shortly, and the Chinese Communist Party will be celebrating its 100-year anniversary soon. It is important to the Chinese government to reach a deal in order to boost their economy, which is experiencing decelerating growth. Officials have communicated to local businessmen that they are dedicated to supporting growth via infrastructure investment, tax cuts, and central bank actions. Agreeing to a deal with the U.S. would further support an economy facing clear structural headwinds. We remain optimistic that a mutually agreeable deal will be put in place sooner rather than later, but recognize that these are complex negotiations between parties with different goals and timeframes. On the next slide, you can see 3 yield curves. The curve in green, I'm just going to start with the basics here. The curve in green is from the year-end 2016, and it's a traditional textbook variety upward sloping yield curve, one that everyone gets taught in business school. In an upward sloping yield curve, the longer the maturity, the higher the yield that investors demand. But typically, there's a sharp rise in the front end of the curve, with rates starting very low and moving sharply higher as maturities go from just a few months out to 5 to 10 years. At that point, the curve kinks so that the slope remains upward trending, but at a much slower rate. While this is the classic textbook version, upward sloping yield curve, it is not the type of yield curve that we have been having currently. Our current yield curve, which is shown in orange, starts at about 2% for very short-term maturities and then goes down, bottoming out at about 1.6% for the 5-year maturity. It then begins a slow rise for longer maturities at a very gradual pace, reaching just 2.2% for the 30-year bond. So for the very short-term maturities out to 5 years, the curve is downward sloping or inverted. Beyond that, it is very flat. And this is somewhat unusual, but it's occurred due to what's going on globally. Foreign investors seeking safety, and believe it or not, chasing yield as their rates are even lower than ours, have invested heavily in this part of the yield curve, pushing yields down further. Another important point that this chart shows is just how low our domestic interest rates are. With a 5-year yield recently as low as 1.35% and a 10-year under 1.5% earlier this month, rates have been near their historic lows. The blue line is the yield curve at the beginning of 2018. And we can see that rates, which were low then, have continued to trend lower across all maturities. But this isn't just the U.S. trend. The world's central banks through NIRP, which is negative interest rate policy, have pumped so much liquidity into the system that interest rates have been suppressed around the world. We can see on the table on the right that bond rates for the UK, Japan, France, and Germany are even lower than the US. Rates for Japan, France, and Germany are even negative. So a purchaser of these bonds actually pays the government for the privilege of lending that government money. And it's not just 10-year maturities where this is the case. In Germany, all sovereign debt is negative across every maturity. This is becoming a worldwide phenomenon. Bank of America recently reported that the U.S. share of positive global investment grade yields of bonds actually paying interest to the lender is now 94% globally and could be 100% soon. Central banks around the world control short-term interest rates, and they've been pretty well coordinated in their actions this year. So far in 2019, 20 different and separate central banks have made changes to their interest rate policy. Of those, 18 have cut rates, and only 2, Norway and the Czech Republic, have raised rates. And neither of these countries is in the top 25 countries of world GDP. They're very minor players in the global economy. Earlier this month, the ECB, the European Central Bank, lowered its interest rates by 10 basis points to a record low of negative 50 basis points and ordered a new round of quantitative easing starting in November. And quantitative easing drives down yields even further. So while U.S. rates are currently positive, former Fed Chairman Alan Greenspan said in August he sees no barrier for U.S. yields going negative, and President Trump called on the Fed to drive interest rates negative to stimulate the economy. While we're not sure if U.S. rates will eventually go negative, it is apparent that rates are low and going lower, both here and abroad. All right, so this slide shows the spread between the 2-year Treasury and the 10-year Treasury. It's one of the key indicators that we follow to determine when a recession is going to occur. When the 2-year Treasury inverts with the 10-year, meaning that the 2-year Treasury is at a higher rate than the 10-year, it is a sign that a recession may be on the horizon. History tells us that on average, the U.S. will enter a recession 9 to 18 months after this happens. The chart on this slide shows the spread between the 2-year and the 10-year going back to 1977. And since then, it has inverted or gone negative 6 times. And in 5 of those times, the economy has entered a recession, as noted by the red circles. Recessions have occurred on average 14 months after the first inversion during these times. Now, you may have heard that the spread inverted recently. Certainly, the financial media highlighted it all over the place. And in actuality, the spread did invert by a couple of basis points for less than a day. This isn't what we would call an inversion. Following that occurrence, which one of our large cap value managers called the 90-minute inversion, the spread has reversed course and was a positive 8 basis points as I was walking into this meeting. Last week, some of us attended an investment conference where one of the speakers addressed this, saying for the indicator to be reliable, it requires a couple of weeks of inversion at a 20 to 25 basis point level, not a few hours at 2 to 3 basis points. Should the spread reach that level for a few weeks, the recession would follow 12 to 15 months later. And just quoting an economist at JP Morgan, he said, the fact that the 2s10s inverted is less a reflection of U.S. recession risks and more a reflection of the desperation for yield by foreign investors looking to U.S. dollar-denominated bonds as yields in Europe and Japan become more and more negative, which we saw on the previous slide. And we speak with a number of economists, and none of them believe a recession is imminent. One believes that the chances of a domestic recession are pretty low, given the current economic climate and strength of the U.S. consumer. He does, however, believe that the global economy will remain weak, and at a point, this could be problematic for the U.S. He feels that trade talks with China will eventually have a solution that is acceptable to both sides, but that a complete breakdown in talks could be the tipping point for lower growth here in the U.S. We do believe that the next recession will not have the depth or length of the great global recession of 2008 and 9. That recession was driven by a systematic lack of liquidity, leading to the near collapse of our banking system. These factors are currently under control. The severity of the next recession, whenever that might be, will be mitigated by the underlying strength and resiliency of the economy, the consumer, and the financial system. Excuse me. So we keep hearing and reading that the economic recovery is long in the tooth, but it is our belief that recoveries don't end because of old age. They end because the pace of growth is too strong, leading to inflation, and the end is higher interest rates used to combat inflation suffocate the ability for businesses to grow and expand. Now, we've already discussed that inflation is not heating up and interest rates are near historic lows, so those are not issues in the near term. The current recovery is more than 10 years old, but as you can see on the slide, this recovery could still have a while to go. Since the end of the prior peak, which occurred in the fourth quarter of 2007, the economy has experienced cumulative real GDP growth of about 20%, as shown by the dark blue line with the dots after it towards the bottom of the chart. There have been 10 other economic recoveries over this period, with 4 surpassing 25% cumulative growth, 3 surpassing 30%, and 1 near 50%. Another 3 have reached about 20% where we are now. Years of the economy grinding along at 1 to 2% growth have prevented the current recovery from gaining any momentum, keeping inflation subdued and interest rates near historic lows. Based on the weakness of this cycle, the longevity of the economic recovery has already exceeded all prior recoveries, and based on previous experience, may still have a while to go. So on this slide, you can see the federal funds rate over the past 19 years, with projections for the next 3 as delineated by the dotted lines, red for the Fed and gray for market expectations. I should note we prepared this chart before today's announcement, but the announcement basically came in as expected, 25 basis points, and it's pretty much factored in, so I wouldn't expect these numbers to change significantly. Just as a review, the Fed began tightening rates in late 2015 and continued through December last year. In July of this year, the Fed changed course, and for the first time since the recession of 2009, cut rates by 25 basis points. As Bob mentioned, today the Fed cut for the second time, going to a range of 1.75% to 2%. The market expects the Fed to keep trimming rates and has a 1.56% target by year end. That would mean another 25 basis points cut approximately, and they have a 1.03% target by the end of next year, dropping to under 1% in 2021. Once again, that's before today's actions. In summary, there's clearly been a shift away from tighter monetary policy, which was in place over the last few years. The Fed is becoming more dovish and more accommodating to lower rates, which is typically better for U.S. businesses and consumers, leading to an expanding economy. So I think everyone knows next year there's a presidential election. We've already entered the election cycle, as we've seen a number of televised Democratic candidate debates. But here's what you need to know. Over the past 100 years, the incumbent gets reelected if the economy has not been in a recession in the 2 years leading up to the election. and the incumbent loses if it has. Over that time, there have been 11 instances when an incumbent has run and there's been no recession, and every single time they've been reelected. During the past 100 years, there have been 6 instances when an incumbent has run and there was a recession, and only once was the incumbent reelected, and that definitely comes with an asterisk. As historians will note, in late 1923, Calvin Coolidge unexpectedly became president. He ran for re-election less than a year later, and the economy was just emerging from a recession, which clearly was not his responsibility. He was reelected. So this indicator is fairly clear. President Trump should be reelected as long as the economy continues to expand. Should it enter recession prior to the election, he will most probably be defeated. He has been doing all that he can to ensure that the economy remains strong. As one of our large cap growth managers told us earlier in the week, Trump does not want to be seen as a one-term loser. He is doing what he can to get reelected, which means driving the economy. He will make a China deal. He is badgering the Fed to keep rates low, and they recently proposed a middle-class tax cut. Trump's self-preservation will prevent the recession in the near term. Besides the economy, there are a number of other hot-button issues you're going to hear more about. Those include healthcare, immigration, climate change, tax reform, and student debt. So a recent addition to the wall of worry is the new type of warfare which has become more commonplace, and that is the use of drones and missiles to fight battles and express hostilities. Earlier this summer, Iran shot down a $220 million United States unmanned surveillance drone over the Strait of Hormuz, claiming it violated their airspace. The incident occurred amid rising tensions between the two countries and nearly resulted in an armed confrontation. This past weekend, a Saudi Arabian oil processing plant was struck by drones and missiles. The attack is believed to have been initiated by Iran. The damage resulted in the cessation of nearly half of Saudi Arabia's oil production. Saudi Arabia is responsible for about 5% of global production. So this is a major blow to global supply, and the price of crude oil reacted by jumping 15% on the first trading day following the attack. Should the plant be offline for an extended period, it will clearly affect the global economy. In the U.S. alone, every dollar increase in the price of crude oil costs us about $7 billion a year. That would be a considerable drag on U.S. consumers' discretionary spending. In response to the attack, this morning, President Trump asked the U.S. Treasury to substantially increase sanctions on Iran, and according to published reports, a range of military responses are being proposed. And while it's not definitive there will be a military response, Iran has warned the U.S. that any attack will lead to a broader Iranian military retaliation. And that could create a vicious cycle of responses and retaliations. Over the years, there have been numerous conflicts that have arisen in the Middle East, and they seem to be addressed for the most part quickly and without much effect on the global economy. However, some investors are concerned that technology has now advanced to the point where it is easier, quicker, and less expensive from both a financial and human capital standpoint to carry out hostile actions, and that could have more of an impact on the global economy. There are, of course, other blocks in the wall of worry. Investors fret about upcoming earnings announcements, rising debt levels for both the government and corporations, the effect of Brexit, political dysfunction in Washington, as well as the growing budget deficit. But we believe that most signs are pointing positive for the U.S. economy at this point. Thank you once again for joining us. I'd now like to introduce Brian Gamble, Vice President of Wealth Management, who will discuss our investment approach.
Thank you, Phil. So I'm going to take you through our investment approach given the environment that Bob and Phil have laid out. Many of you have seen this page in our presentations before or on our webinars. This is kind of how we look at the investing environment. We break it down into 4 baskets: security investments, defensive strategies, traditional equities, and private investments. So these are the way we group our strategies and how we look at things. And at this point, our approach has been pretty steady recently, and we're making a small tweak today to our overall recommendations. We continue to underweight fixed income with a focus on quality. I'll get into the reasons why later on. We continue to overweight the defensive strategies, even more so given the current environment. This is where we've made a small changes in our approach to traditional equities, moving from a very modest underweight to a more modest underweight, given a somewhat fuller, although still reasonable valuation, as Bob mentioned earlier. And we continue to utilize private investments as opportunities arise and where appropriate. And obviously, this overall framework is customized to each client and his or her individual needs and situation. So fixed income. Our continued approach of underweighting fixed income is a result of the current low interest rate environment. The solid portion of the bars on this chart represent the yield net of federal tax. And as of August 31st, all four of these fixed income categories are yielding below the rate of inflation, which means that the investor is losing purchasing power or not able to buy as much in the future, given the current level of investment and return on that compared to the rising prices of consumer goods. The second slide here relating to fixed income compares the compound results of remaining invested over a long period of time. Cash, the green line, has shown to be a poor investment over longer periods of time, barely returning 47% over a 22-year period. Fixed income has been a better option, although with rates quite low, as we just discussed, we expect return going forward to be challenging. While equities have certainly been more volatile, the compound results speak for themselves, even when including two recessions and a difficult fourth quarter last year. The key to being able to weather the spikes in volatility in the equity markets and stay the course is having the proper asset allocation, which is why, despite the difficult interest rate environment, it is important to have a fixed income allocation as an anchor for more volatile times. As I said earlier, we recommend that clients continue to overweight defensive strategies as they are designed to mitigate volatility, minimize downside capture, while still capturing a significant portion of market appreciation. Examples of defensive strategies include hedge growth with a bias to growth companies, dividend growth with a bias to value companies, and multi-strategy hedged investments with a bias to credit. Focusing on dividend growth, it is not just about finding companies with the highest yield, but about finding companies that are able to sustainably grow their dividends at an attractive rate. It is important that a company be able to grow its current dividend while also reinvesting for future earnings growth that will ultimately drive future dividend growth. Companies that have high yields may be at a higher risk for a dividend cut or may be hard-pressed to continue growing the dividend at an attractive rate while still investing for future growth in the business. As the chart shows, those companies that are successfully able to grow their dividend, as represented by the darker line, have generated significantly better returns than those that have high yields and are forced to cut their dividends. We made a slight change to our recommendation for traditional equities, moving from very modestly underweight to modestly underweight, as valuations have become a bit fuller. This is particularly true when you look at the valuations among the different asset class categories shown on this slide. Valuations point to value-style investing being more attractively valued versus historic levels. However, low interest rates favor growth companies as their future earnings are worth more when discounted back to today. Given the significant difference in valuations, we are starting to shift a little bit more towards value. Additionally, within traditional equities, we continue to underweight international equities, given the weaker growth, especially in Europe, as well as China continuing to slow. And with that, I'll hand it back over to Bob for our summary.
Thanks, Brian, and thanks, Phil. So in summary, 2019 thus far is producing reasonably strong returns across virtually all FLI strategies. U.S. GDP and corporate earnings are both projected to continue to grow, although at slower rates than in 2018. Companies are continuing to reap and reinvest the benefits of the Tax Cuts and Jobs Act of 2017, and individuals continue to see some benefits from that tax reform as well. Valuations, for the most part, are near the historical norm, and in some cases attractive, especially given the current interest rate environment. And I can't emphasize enough, as has been throughout this presentation, those very low interest rates are supportive of higher valuations and actually support equity investing. Headlines of trade wars and tariffs, interest rates, politics, domestically and internationally, et cetera, have caused and will continue to cause volatility. That is nothing new. For as long as I've been in this business, which is roughly 40 years, volatility has been something every investor has had to face. And withstanding that volatility and weathering it has led to significant returns compounded over time. So volatility, in the words of Warren Buffett, is an investor's friend. And we have to view it as that, although it's uncomfortable when we're going through it. In our opinion, concentrated portfolios of companies with strong fundamentals should prove successful over the long term, especially as GDP growth slows and earnings growth for the S&P slows. Being able to be invested in concentrated companies that will perform well over the long term should do very well for us in the future. As Phil pointed out, despite moments of slightly inverted yield curve, the 90-minute inversion I think he pointed out, we do not see a recession in the immediate future. And I would define the immediate future as certainly over the next year. We remain committed to selective opportunities in real estate and private equity, as Brian pointed out, on an opportunistic basis as we see them and as we see where it fits with each of our clients as we customize their asset allocations. We continue to believe being patient with a prudent asset allocation that's customized to each client's needs with an overweight to defensive strategies is the best course for most investors. And we believe that our defensive strategies have fared very well over the last several years and will continue to. So that's why we're tilted to a bit more defensive given the current environment that we've described. And with that, I will turn it over to Karen. Thank you very much for listening, and we'll entertain questions.
Bob, Phil, Brian, thank you all so much. We now will begin the Q&A session, so please feel free to type your questions in the questions box on your screen. The first question we have talks about interest rates. So I'm going to send this one over to Edward Pileski, our fixed income portfolio manager. Ed, what do you make of the current low interest rate environment, and what effect do you think that will have on inflation?
Thank you, Karen. We believe that the low interest rate environment is partially a reaction to concerns of an imminent recession, and as Bob just pointed out, in our opinion, that's simply overblown. Rates are low internationally, with the European Central Bank remaining accommodative and indicating that they will be taking on measures to stimulate the Eurozone economy. Domestically today, as Bob, Phil, and Brian stated, the Fed announced another 25 basis point rate cut. What the Fed does regarding interest rates going forward will be data dependent. If the economy materially weakens, there's likely to be more rate cuts. But the key is the U.S. is currently not in a high inflation environment. With the PCE deflator, which is the Fed's preferred measure of inflation, currently, and for some time now, that's been well below the Fed's target level. Finally, there's also renewed optimism of a resolution to the U.S.-China trade conflict with the announcement of a meeting in October. This will also, in our opinion, abate some of the inflation concerns out there.
Excellent, thank you. The next question we have is that overnight repo rates over the last few days have spiked. Do we see this as a warning signal?
Brian, I'll let you take that.
Okay. No, we don't see this as a warning signal. This was a very short term, driven by very technical factors, primarily driven by corporate. And the Fed just needed to step in and provide a little bit of liquidity, especially given the increased regulations on the banks and their needs for capital requirements. And the shrinking of the Fed's balance sheet all kind of coincided at this one particular moment. So the Fed stepped in just to provide an additional bit of liquidity, but we certainly don't view this as a warning sign or any concerns there.
Yeah, just to hitchhike on that for 1 second, since the recession and regulations that were put in, our major banks are holding more capital than they ever have, and they're incredibly strong. virtually all having passed numerous stress tests. So we remain quite confident that our financial system is in excellent shape and certainly much better shape than it was during the recession that I referenced earlier.
Great. And our next question is, you talked a little bit about the difference between the valuations on the growth and the value side. You talked about that growth has been outpacing value. Where do you see that going in the near future?
That's an interesting question and one that everybody is asking themselves on a daily basis. We had a call this morning with one of our outside managers who's a large cap growth manager, and they pointed out something that we know, but sometimes investors don't focus on, and that is the duration of growth. And all companies are not created equal. So in terms of growth companies, we try and invest in those growth companies that have long duration. In other words, they can grow their earnings year after year after year because many of them are following secular growth trends. An example would be we own Visa, MasterCard, and PayPal among our different strategies. And they are taking advantage of the trend, the global trend to go from cash and checks to plastic and electronic transfer. And that's a process that will be ongoing for years and years to come. So the duration of their growth is very long. And for that, investors are willing to pay up, and therefore there are premium PEs paid for those companies. Value companies are more cyclical, and they don't have that long duration growth or the robust growth that those companies have. Now, we don't have a crystal ball, and investor sentiment can play into how different strategies perform. So as you all know, we have emphasized having a prudent asset allocation. And within that asset allocation, we have both growth and value. We have been biased to growth for many years now, and that has paid off. We continue to have some bias towards growth because we think in a slowing economy with slowing S&P earnings and slowing GDP, those growth companies at current valuations are still attractive. So again, let me emphasize, we want to have allocations to both growth and value. Right now, we continue to be somewhat biased to growth, but given the valuations on value, we're looking hard at that as well.
Thank you. I think we have time for one more question, which is, why would an investor make an investment in a bond with a negative yield?
That's a good question.
Take that one.
Well, I think the key is the reliability and the steadiness of that coupon, that steady stream of income coming in. You look at the rates in Japan and Germany, and they're investing in negative rates. But I think for some of those governments, they have to invest as part of rules and regulations. They have to invest in domiciled yields that are offering negative interest rates. So there might be some rules and regulations where, not being forced, but they're almost obligated to invest in those domiciled bonds, at least for Germany and Japan.
Yeah, let me hitchhike on that as well. The pension funds, sovereign pension funds, sometimes are required to purchase their bonds. And those countries are trying to stimulate growth because they have very slow growing, if growing at all, economies. And one way to incentivize companies and investors to invest in things that grow is to offer them a negative interest rate. So yes, there are government regulations, to Ed's point, that prompt pension funds and certain investors to invest with a negative yield, but at the same time, those negative yields are forcing many companies and investors to invest on a global basis in things that will produce some economic growth. But candidly, that's why, as we pointed out during this presentation, there are many foreign investors who are attracted to the U.S. 10-year Treasury, because even at 1.7 or 1.75%, where it currently is, that is one heck of a bargain versus a German bond, a German 10-year bond at negative 50 basis points, even with a little bit of currency risk involved.
Thank you. So on behalf of the entire team at FLI, I want to thank everyone for joining us. We hope you found the session interesting and insightful. For our clients on the line, I want to remind you that our investment committee is always available to discuss your individual asset allocation. And I'm also pleased to announce that our next thought leadership will take place in early November with John Ledecky, the owner of the New York Islanders. Invitations and details will be coming out soon, and we hope you'll join us. We wish everybody a happy afternoon and a great start to fall. Thank you so much.
Thank you.